If you are an immigrant in the UK and you're not using the stocks and shares ISA, you are voluntarily paying more tax than necessary. You are working inside the system without owning part of it. That's the uncomfortable truth. Most immigrants believe wealth in the UK comes from working longer hours, starting a side hustle, buying property, or chasing the next trendy investment. The majority of the long-term wealth in this country is built quietly inside a tax-efficient structures most people ignore. And one of the most powerful of these structures is the stocks and shares ISA. Not crypto, not day trading, not flipping of houses. A tax-efficient wrapper. Boring wins. Here's what I'm going to prove to you today. If you're living and working in the UK, especially as an immigrant, the most reliable path to building long-term wealth is consistently investing inside a stocks and shares ISA, using it as a tax shield to compound ownership in global businesses. Not hype, not luck, just structure. Hi, I am Rishi, your money coach. My mission is simple: to help immigrants in the UK master their money, understand financial tools, and make smart choices that grow their wealth. I'll show you how to move from earning to owning and building a secure financial future so you can stop living paycheck to paycheck and start creating real financial freedom. By the end of this video, you will understand why this tool is underestimated, how it quietly creates six figures portfolio, why most immigrants delay it and regret it later, and how you can start realistically. Let's dive right in. Our first generation immigrants who came to this UK in the 1980s and 1990s built wealth primarily through small businesses, property ownership, community lending circles, and cash savings. For many, property became the golden ticket. Between 1995 and 2015, UK house prices increased over 250% in many regions. If you bought house early then, you won. But here's what is rarely discussed. The FTSE 100 index, including investor dividends, delivered average annual returns around 7 to 8% long term. The global stock market historically has averaged around 8 to 10% annually over multi-decade periods. And unlike property, no tenants, no repairs, no mortgage stress, no stamp duties, no maintenance. Yet immigrants disproportionately focus on property because it was visible. Shares were invisible, and invisibility feels risky. But historically, equity ownership has been one of the most powerful long-term wealth creators globally. Notice something: the wealthy did both. Most immigrants did one. Today, in 2026, the UK ISA allowance remains £20,000 per year. There are over 12 million ISA accounts in the UK, but a large percentage of them are cash ISAs, earning interest barely above inflation. Meanwhile, the Office for National Statistics reports that the wealthiest 10% of the household own nearly half of the UK's total wealth. Why? Ownership of financial assets, not income alone. The median UK salary sits around £34,000 to £36,000 depending on your region. That salary alone does not create wealth. Asset ownership does. And here's where many immigrants unintentionally fall behind. They focus on sending money home, they hold excess cash, they delay investing, they wait for more stability. But time is the real asset. Let me show you something practical. If you invest £300 per month inside a stocks and shares ISA at an average of 8% annual return for 25 years, end up with roughly £275,000 to £300,000. That's from £90,000 invested over time. The difference is compounding. Now, imagine delaying that by 10 years. You don't just lose 10 years, you lose the most powerful compounding years. That delay can cost you six figures. Before we continue, if you are currently living in the UK and you do not have a stocks and shares ISA open, comment ownership below, because awareness is step one. What the wealthy quietly do. Let's observe patterns. High income professionals in the UK routinely max out their ISA allowance, contribute to the pensions, invest in index funds, optimize tax efficiency. Notice what they are not doing constantly. They are not trading daily, jumping between hype assets, waiting for the perfect time. If the ultra wealthy rely heavily on structured tax wrappers, why are immigrants chasing volatility? Because volatility looks like opportunity. Stability looks boring. But here's something critical. If your investment account is taxable, capital gain tax and dividend tax reduce compounding. Inside the stocks and shares ISA, we have zero capital gains tax, zero dividend tax, zero tax on withdrawals. So over 20 to 30 years, that tax shield can increase your ND portfolio by tens of thousands of pounds. The ISA is not about higher returns, it's about protecting your returns. Let's consider a case study of an IT contractor immigrant in the UK earning £75,000 annually. The income was good but inconsistent. No structured wealth plan. Started investing £500 per month into a global ETF inside an ISA. Instead of trying to pick tech stocks, he bought global exposure. So over 12 years, with consistent investing and market growth, his ISA crossed £120,000. Now, his investment generated dividend income annually without him working extra hours. Let's consider the second case study of a retail worker earning £28,000 annually, who believes that investing is for the rich. Started with £150 per month into an index fund inside an ISA. Automated it, ignored news cycles. So after 18 years at average market returns, portfolio exceeded £80,000. More wealth than she ever accumulated in savings before. Let's consider the third case study. An immigrant professional who waited until age 42 to begin investing. Fear of risk. Started investing £600 per month. Focus on consistency rather than catching up aggressively. So even with a late start, tax-free compounding changed retirement projections significantly. If you have ever delayed investing because you felt it's too late, pause this video. Write in the comment section, delay is expensive. The emotional barrier immigrants face. This part is rarely discussed. Many immigrants associate investing with gambling because back home financial systems were unstable. Currency collapses, bank failures, political instability, so cash feels safe. But in the UK, regulated financial markets operate differently. ISA provider is regulated by the FCA, so investor protection exists. The system is not perfect, but it is structured. And ignoring structured opportunity because of past instability can cost you future stability. So where is this going? Looking ahead, say 20 years. Automation will increase, AI will expand, global companies will scale further, equity ownership will likely remain one of the primary drivers of wealth accumulation globally. The gap between asset owners and income earners may also broaden, and the question becomes, will you be participating in ownership or only participating as a labor? That is the structural choice. If you want the step-by-step breakdown of how to open, structure, and invest properly inside the stocks and shares ISA, download my free ISA Starter Guide book. Link is in the description. No hype, just structure, because structure beats motivation. We'll go deeper in this part. Exactly what to invest in, how to think about risk properly, the biggest ISA mistakes immigrants make, and how to future-proof your strategy. the pattern why this outcome is predictable. Let's slow this down and extract the real pattern. The IT contractor, the retail worker, the late starter. Different incomes, different backgrounds, different fears, but the same structural decisions. They chose ownership over consumption. They chose tax efficiency over trend chasing. They chose time over timing. And that's why the outcome was predictable, not lucky, predictable. When you combine consistent contributions, long-term exposure to global productivity, a tax-free growth structure, and patience, the probability of long-term wealth increases dramatically. Historically, global equity markets have returned roughly 8 to 10% annually over long term. Not every year, some years negative, some years explosive. But over decades, productive businesses grow because population grow, innovation increases, efficiency improves, consumption expands. When you invest broadly, you are not betting on one company. You are betting on human progress. And historically, that has been a rational bet. Next, we'll be looking at the mistakes that most immigrants make. Mistake number one, opening a stocks and shares ISA and never investing the cash. Yes, this happens. People deposit money but leave it sitting idle. That defeats the whole purpose. Mistake number two, trying to pick the next big stock. Remember this, professional fund managers with research teams struggle to consistently outperform the market. You working full time, scrolling after dinner are unlikely to beat them long term. Mistake number three, panic selling during downturns. In 2008, market fell sharply. In 2020, during the pandemic, market dropped dramatically. In 2022, inflation caused volatility. Yet, long-term investors who stayed invested recovered and grew. Market downturns are not system failures. They are structural cycles. Mistake number four, waiting for the perfect time. There is no perfect entry. There's only one time in the market. If you currently have money sitting in a cash ISA, earning low interest, while inflation averages around 3 to 5%, ask yourself honestly, is safety costing me growth? Write that question down. Next, we'll be looking at facts and figures of what compounding actually does. Let's remove vagueness. Here is a simplified illustration. If you invest £200 per month at 8% average annual return for 30 years, you contribute, say, £72,000 in total. Your potential portfolio value, approximately £280,000 to £300,000. That difference of over £200,000 is compounding. Now consider if you wait 10 years before starting, you invest the same £200 per month for 20 years, you contribute £48,000. Your potential portfolio, roughly £115,000 to £120,000. You delayed yet again another 10 years. You've lost £150,000 in potential value. Time is the multiplier, and most immigrants underestimate it because survival thinking prioritizes short-term stability, but wealth requires long-term thinking. Next, let's address it honestly. Stocks and shares ISA are not guaranteed. Market fluctuates, values go up and down. If you need your money in 2 years, equity are risky. If you are investing for 15 to 25 years, risk reduces historically. Volatility is not the same as permanent loss. Broad diversification reduces company-specific risk. Time reduces short-term volatility risk. Tax efficiency improves net outcomes. We must separate speculation from structured investing. They are not the same. Next, the macro forces shaping the future. Now, let's look forward. The UK economy will continue evolving. AI and automation will increase productivity. Global corporations will likely expand into emerging markets. Digital infrastructure will dominate supply chains. The investors who own diversified global funds will indirectly own technology growth, healthcare innovations, energy transitions, consumer expansion. So you don't need to predict which companies wins. You need exposure to the ecosystem. This ISA allows that exposure without tax friction. And here's something structural. As governments face increasing fiscal pressure, tax optimization becomes more valuable. If tax rates rise in the future, tax-free wrappers become even more powerful. The ISA is future-proofing. If you are serious about building structured wealth in the UK, download the free ISA Starter Guidebook in the description. It breaks down how to open the account, how to choose funds, how to automate properly, what fees to avoid. No hype, just clarity. Let me speak directly to those in their 40s and 50s. Many immigrants say, I wish I knew this 20 years ago. But regret is only useful if it informs action. The second best time to start was 20 years ago, and the best time is now. So even 10 to 15 years of structured investing can transform retirement stability, especially when combined with pension contributions. Remember, wealth is not about impressive people today. It's about protecting your future itself. Next, if you are not trying to become a hedge fund manager, you are not trying to beat Wall Street, you are trying to protect purchasing power, grow capital steadily, reduce tax leakage, build optionality. Optionality means the ability to reduce work later, the ability to support family, the ability to say no. That's real wealth. And it's built through discipline, not drama. Let me give you something grounded. Build a 3 to 6 month emergency fund in cash. Step 2. Open a stocks and shares ISA with a regulated provider. Step 3. Choose a broad global index fund or diversified ETF. Step 4. Set up automatic monthly contributions. Step 5. Not a short-term noise. View annually, not daily. That's it. Simple does not mean weak. Simple invested constantly becomes powerful. If you plan to open your ISA within the next 30 days, comment 30 below. Public commitment, increase, follow through. Immigrants often arrive in the UK focused on earning, but earning alone rarely creates wealth. Ownership does. The stocks and shares ISA is not exciting. It won't give you viral bragging rights, but over 20 to 30 years, it can quietly shift your entire financial trajectory. When people look at stable retirees and say they were lucky, they weren't lucky. They were positioned. ISA is positioning. And in a world that rewards ownership, positioning matters. If this perspective shifted how you see investing, download the free ISA Starter Guide. Study it, apply it, and build structurally. Because in the UK financial systems, boring, disciplined ownership will win. Thanks for watching. See you in the next clip. Cheers, guys.